The market trends differ from time to time. Understanding the market trends is crucial as it helps the insider navigate investing strategies. As an investor, the market's direction has a huge impact on your investment portfolio. Regardless of a stock market, cryptocurrency, or real estate, the markets are described as one of two ways. It could be a bull or a bear market. Both of these phases are opposite to each other. The discussion provides a detailed overview of bull and bear markets. Their characteristics would also be covered that differentiate between the two. So, time to begin. Where do the terms bull and bear come from? There is no sound logic between both terms. However, most experts believe that the terms were named with how these animals attack. As bulls thrust their horns upward, the bull market signifies the economy's growth, and the market is on the rise. Similarly, bears swipe downwards with their claws, so the bear market represents a receding economy. In short, a bull market shows a sustained increase in prices, while the bear market displays otherwise. The bull market. The bull market is defined as the substantial growth of stocks or a crypto asset. It is a period when a wide range of investors are buying, which enhances the demand and gives rise to the asset's value. When a market is witnessing a rise in prices, it is known as the start of a bull market. Additionally, the bull market is in full swing when the stock prices have enhanced up to 20% since the last time. The economy is sound in the bull market as most traders are full of optimism and hope for future growth. The insiders who have a firm belief in the increase in prices are known as bulls. The enhanced confidence of the investor creates a positive loop that draws in further investment, and prices continue to grow. One can count on the bull market for good employment opportunities, strong demand, and long strategies. The bull markets do not last for a lifetime, and there is always something that wavers the investor's confidence in the investments. It could be triggered by unforeseen circumstances such as unfavorable legislation or COVID-19. The bear market. The bear market can be described as the substantial decline in the value of the assets. It is a time when the supply is greater than the demand, which exponentially reduces the price. The insiders with flawed confidence in the stocks give rise to the bear market. Resultantly, these insiders are known as bears. The bear markets are difficult to trade due to pessimistic bears. It is complicated to predict when the bear market will end because the rebounding process is slow. In a bear market, the prices continue to decline and are characterized by people losing their jobs. With that, the gross domestic product declines and the stock market loses significant value. With the economy slowed down, most investors find it the right time to invest. It is because the long-term investors are paid off as soon as the cycle reverses. It highly depends upon the investment strategy. The bear market doesn't last as long as the bull market. Therefore, insiders do not mind investing in the phase. Difference between the bull and bear market. Now that we have a complete understanding of the bull and bear market, let us shift our focus to the difference between the two. It will help the traders and big business tycoons better understand the market trends. As mentioned above, the stock prices are increasing in the bullish market and declining in the bearish market. It is one of the most important differences between the two. Similarly, the bear market is associated with economic depressions and recessions. Recessions occur when the GDP has declined for 2 quarters, and depressions are linked with a GDP decrease of 10%. However, the bull market witnesses an increase in GDP due to the enhanced revenue of companies, leading to high employment and consumer spending. The third difference between both of these markets is inflation. When the economy is booming, the bull market presents a significant level of inflation. The high demand for products enhances the prices, causing inflation, whereas the shrinking demand lowers the prices, triggering deflation. As far as the interest rates are concerned, low rates are accompanied by the bull markets, and the reversal is true for bear markets. The low interest rate allows the brands and companies to borrow money and enhance their growth. The growth leads to a better economy. On the other hand, the high interest rate limits the company's expansion and gives birth to the bear market. Got about the basics of the market? While you witness a bull market, the investors are expected to take advantage of the rising price and invest in the assets early. After that, it can be sold when the stocks have reached their peak. As for the bear market, one can invest in more equity and make profits through safer investments such as income securities. the bullish and bearish markets were introduced and how both should be used to one's advantage. Investors and business tycoons are recommended to review the market condition before emptying their